Good day, fellow investors. Heineken is getting cheap. Maybe not the beer, but the stock is cheap. Don't get confused by the P ratio, some impairments there, no worries. But the dividend yield is there, the stock is down. The market might be looking at it from a wrong perspective. The business is still growing, revenues going higher, volumes, everything is going higher. And I've put here Heineken on the better end of the market to show you that it is cheap, and we'll discuss the risk and reward at the end of the video. Now, net revenues, currencies, that's just temporary. Currencies goes up and down, nothing to worry. The rest, growth there, growth in volume, premium price, profitability, whatever. There has been an impairment on their Asian investment. They own a stake in CR beer, China Resources beer, and they bought it, and then as it goes below the price they paid, because the stock on the Hong Kong Stock Exchange went down, they need to impair the acquisition, and that's why you see the decline in the net income. However, the company there is also doing good. The P ratio is 15, the dividend yield is 3%. If I look at the numbers, they have been growing, nothing wrong. So let's first look at Heineken. I think the growth will be there like 3% going forward. The real net income, apart from the impairments, value creation is around 3 billion on 40 billion market cap. Not bad for Heineken. 1 billion for dividends, and they also doing their acquisitions that they have done in the year, the China Resources acquisition investment, but the total equity is also growing. So we have 1 billion in dividend, likely 1 billion, a little bit more in growth. So when it comes to things, I think that Heineken is fairly priced in the environment. The dividends have been growing, will likely continue to grow, and nothing wrong with Heineken. 2-3 billion of value creation now is on the cheap side, especially cheap when compared to the market. Of course, to make me interested, wake me up if it is at 30 billion, as I like 10 plus investment returns, 10 plus earnings yields, higher dividend yields. So for now, it's good from that relative perspective. I've taken a look also at China Resources beer holding. They have Heineken, they have other things, but they are also going into the premium alcohol in China. They bought it in 2019, a stake there. And if we look at the revenues, have been steadily growing, operating income steadily growing, nothing wrong with the company. Alcohol, beer business, a little bit stagnant, maybe we'll catch up in the future, but this Baijiu business is growing, they are profitable, net cash, everything looks good, growing, growth. Now this is something I don't like Heineken, they are going to construct headquarters, base and beer town and things like that. This might also be something like Heineken, that they are investing also in a new research center. That's nice, but that's not really something that increases shareholder value. Phase 2 exploration, now they are in development, and there could be a big boom on the, let's say, premium side of the market. This is the company, the guidance is good there, and I would say nothing wrong with both companies. Maybe I should push Heineken here to 6-7%, a little bit more, but it is on the better end of the market if you ever wanted to own it. Now it might be the time to own. Perhaps a little bit recession also counter-effective if there is a recession. Protection against inflation if they can increase prices. So nothing wrong, relatively a good buy. Thanks for watching. I'll see you in the next video.